They told you it couldn't happen. They told you the dollar was fine. They told you the spike in gold and silver was a fluke, a meme, a mania, a temporary panic. And yet here we are, watching the floor crack beneath the world's most important currency, while the metals market refuses to calm down. And quick favor before we go any further. I'm running a campaign to eliminate copycat channels that steal the work and recycle it. If you value what we do here, support the campaign by subscribing and commenting. Now let me set the stage. And I know some of you are thinking, okay, but everyone says the dollar is the cleanest shirt in a dirty laundry basket, so why would it break now? Fair question. Because currencies don't just trade on who's best, they trade on marginal change. If the US is getting worse faster than the alternatives, the dollar can fall even if everyone else is a mess too. That's the trap people miss. Here's a simple example. Imagine two runners. One is already ahead, but he twists an ankle. The other guy is exhausted too, but his ankle is fine. In that moment, the lead can shrink fast. That's what a currency move can look like. Not a moral judgment, just a shifting handicap. And right now, the US handicap is being shaped by three forces at once. First, the rate path. Markets don't wait for official cuts, they price them in. When traders start believing easier money is the default next step, the dollar loses one of its biggest supports, yield advantage. Second, the funding need. When you have to roll and refinance mountains of debt, you're constantly in the market asking for buyers. And if buyers demand a higher return to show up, the system either pays that return or finds a workaround. And the most common workaround is a softer currency. Third, the confidence premium. The dollar has been able to borrow cheaply for decades, partly because the world trusted the rulebook. When investors start asking questions about policy stability, fiscal discipline, and what happens in the next crisis, that premium gets shaved down. Now, none of this is a doomsday prophecy. It's a pressure gauge. And when the gauge rises, metals usually react before the headlines do. Also, let's be honest about what a lot of people are feeling but won't say. They're tired. Tired of official narratives that change every quarter. Tired of being told inflation is transitory, then sticky, then solved. Tired of being told debt doesn't matter, right up until it suddenly matters. That emotional fatigue is part of the setup, too. Because when trust wears down, people stop giving the benefit of the doubt. And that's when a small technical break turns into a trend. So keep that in mind as we rewind, because the history lesson isn't about nostalgia. It's about pattern recognition with real money on the line, because the next few minutes are going to decide whether the move you're seeing in gold and silver is just the warm-up or the start of a full-on repricing that catches most people flat-footed. In the last video, I laid out one simple rule. The precious metals don't put in a real durable top until the dollar breaks down in a real durable way. Not a cute little dip, not a one-day wobble, a breakdown that changes behavior. And for months, this market has been obsessed with one number on the dollar index, 96. That level has been tested and respected like a steel beam. Tap it once, bounce, tap it twice, bounce, tap it a third time, and you start hearing that cracking sound nobody wants to admit is real. Then yesterday, January 28th, we finally slipped under it intraday. And even with the central bank doing its whole, we're watching the data performance. The dollar didn't look strong, it looked tired. Here's what matters. The dollar index doesn't have to collapse overnight for gold and silver to move like rockets. It just has to lose credibility in slow motion. The kind of slow motion where people keep saying it's not that bad, right up until the day it is. And based on recently published numbers and recent market updates, you can see the same pressure building in multiple places at the same time. Debt auctions, rate expectations, and global capital flows that don't care about patriotic speeches. That's why in this video, I'm going to do three things in order. First, I'm going to walk you through what happened the last time the dollar index fell from this exact neighborhood and what gold and silver did while it happened. Second, I'm going to show you what might come after the next support zone, because that's the part nobody wants to talk about out loud. And third, I'm going to address the question I keep getting hammered with. If silver is exploding, do you buy the metal or do you buy the miners? And I'm going to be brutally honest about the upside and the landmines. Before we jump in, check the description. I tucked bonus links down there, including a premium WhatsApp channel link and a channel membership join link. If you want the quick updates and the behind-the-scenes notes without hunting for them, it's right there. All right, let's get into the part the everything is fine crowd hates. Even if you ignore politics, personalities, and headlines, the math is getting loud. The federal debt is now north of $38 trillion updated basically in real time. And when you stack that on top of refinancing needs, the interest bill, and the fact that buyers are getting pickier, the system becomes more sensitive to small shifts in confidence. So when the central bank speaks and the market hears cuts are coming, that's not just a rate story, that's a currency story, because currencies trade on relative pain. If the US is moving toward easier money while the rest of the world is trying to stabilize, the dollar loses its edge. Now, some people heard the latest press conference and took away one message. They're going to cut. Others took away a different message. They can't really do anything else. And that second message is the one that tends to push people into hard assets. At the exact same time, global investors have been rotating in ways that don't show up on your daily news scroll. You can see it in fund flows. You can see it in the way the dollar index reacts to decent data and still can't hold a bounce. You can see it in how quickly gold is being bought on dips. And you can see it in silver, which has been acting like a market with a tight supply chain and a nervous crowd. Silver just pushed above $100 an ounce, printed an all-time high north of 117, and then snapped back hard. That kind of move makes people emotional. Bulls start doing victory laps, bears start screaming top, and everyone forgets the only question that matters. What's the trend under the noise? Here's the key relationship that keeps showing up decade after decade. Gold and the dollar index tend to move in opposite directions. Not perfectly, not every hour, but enough that when the dollar rolls over, gold and silver usually don't need an invitation. So let's rewind to the last clean example of the dollar breaking from this zone. Back then, what made that slide so powerful wasn't just the chart, it was the policy backdrop, massive stimulus, emergency lending programs, and a central bank that went from "we're normalizing" to "we'll do whatever it takes" in a heartbeat. The result was simple: more dollars competing for the same real stuff. Gold reacted first, pushing to fresh highs, and silver followed with that classic delayed slingshot. But the real lesson is timing. The biggest gains didn't land on the day the dollar cracked. They showed up after the market had a few weeks to accept the new reality, after the fake bounces failed, and after people stopped waiting for a quick snapback. That's why a break under 96 matters so much today. The first move grabs attention. The follow-up is what changes portfolios. And when you see silver pause, then rip, that's often forced positioning, not the end of the story. It's the difference between a spike and a cycle. And cycles can run longer than anyone expects. Quietly. The dollar index was hanging around 96 and then slid down toward 90 over a matter of months. That was a meaningful move. Not because 96 is magical, but because it was a signal. The market was willing to price the dollar lower for an extended stretch. And during that stretch, gold didn't politely drift. It stepped higher. Silver didn't tiptoe. It surged. Now, I'm not saying history copies and past performance guarantees anything. What I am saying is that markets rhyme. And when the same setup appears, you pay attention. If the dollar index repeats a move from the mid-9s down toward 90, and if metals respond with anything close to what we've seen before during similar currency slides, then the next leg in gold and silver is not a fantasy. It's a scenario. Think about it like this. If gold adds a modest 10% from current levels during that kind of dollar drop, you're suddenly staring at prices that sound crazy to people who stopped paying attention years ago. And silver, because it's smaller and thinner and more emotional, can move in percentages that make your head spin. And that's where the first cliffhanger hits, because the real story isn't the move to 90 on the dollar index. The real story is what happens if 90 doesn't hold. Because 90 is not just another number. It's the point where, if it breaks, the conversation shifts from temporary weakness to structural change. And that's when the psychology changes for everyone. Savers, institutions, central banks, even regular people who don't care about markets until grocery bills start shouting at them. So, let's talk about the path below 90, and before you assume this is only about the US, zoom out for a second. The same debt math is haunting other major currencies too. Look at the euro area, a shared currency with very different fiscal realities underneath it. Some members can handle higher rates, others can't. That's why you keep seeing periodic stress in sovereign spreads and emergency-sounding language when borrowing costs rise. When the market starts pricing fragmentation risk, it changes how global investors think about holding that currency long-term. Look at the UK, a country with deep markets and strong institutions, but also a history of getting punished when fiscal promises collide with bond market reality. The pound has had moments where it moved like an emerging market currency, and that should tell you something. Confidence can be lost faster than it's built. And look at Japan. Enormous debt, a population dynamic that isn't getting easier, and a bond market that has been held together for years by policy choices that can't run forever without side effects. When yields finally move, even a little, global money has to reprick the entire carry trade structure that depended on low Japanese yields. That's one reason you've seen the yen become a pressure point in global markets. So, the reason I'm bringing up the euro, the pound, and the yen is not to say they're doomed. It's to make one point. The world doesn't have an obvious painless escape hatch. If multiple currencies are strained at the same time, capital doesn't just choose the least bad paper, it starts choosing assets that sit outside the paper game. That's where gold has always lived. And that's why silver has started acting like it wants a seat at that table too. Now, here's the cliffhanger within the cliffhanger. When capital starts moving into metals for monetary reasons, at the same time industrial users keep buying silver for real-world production, the two demand streams can stack on top of each other, and when that happens, price action gets weird fast. So keep that image in your head as we talk about what happens below 90, because the next chapter is not just a chart level, it's a behavioral shift. And I want you to stay with me here because this is where the script flips. If the dollar index falls into the high 80s, the dollar still exists. Obviously, the world doesn't end. Your card still works, your paycheck still hits, but the dollar becomes less trusted at the margin. And at the margin is where markets move. Then if the dollar index slides into the 70s again, like it did in the early 2010s, it doesn't mean America is finished. It means the price of everything else measured in dollars has to adjust. Oil, food, metals, imports, travel. You don't need a dystopian movie, you just need arithmetic. And yes, people love to jump straight to the scary stuff. They're going to ban gold. They'll confiscate silver. They'll kick down doors, slow down. History usually doesn't start with soldiers. It starts with incentives, rules, and pressure. In some countries, when the currency starts bleeding, the first stage looks deceptively normal. Shops open, restaurants are full, tourists take photos, and the skyline still glows at night. But behind the scenes, the savings class is getting punched in the mouth. You've seen versions of this in places where the currency lost most of its value over a handful of years. It isn't a cartoon. It's a real economy with real people who wake up one day and realize the money they saved for a decade buys a fraction of what it used to. How does that happen? Usually it's a mix of three ingredients. First, leaders lean on rates in a way that's politically convenient but financially toxic. They want cheap borrowing, they want growth, they want the illusion of prosperity. Second, bond investors start to step back because nobody likes lending into a system that feels manipulated or unstable. Third, the government fills the gap with money creation directly or indirectly because spending is easier than reform. And then the final twist, when trust breaks, people don't stop needing money. They just stop wanting that money, they start using something else for savings, and sometimes even for big purchases and other currency, hard assets, anything that feels less slippery. Now, I'm not saying the US becomes another country overnight. I'm saying the mechanism is the same everywhere. Confidence is the real reserve. And here's where precious metals come back into the story in a way that's almost boring in its simplicity. When people lose trust in paper, they reach for things that don't need trust. A bar of silver doesn't care who's in office. Gold doesn't need a press conference. They just sit there quietly while humans argue. That's why in countries where the currency weakens dramatically, you almost always see a stronger local culture of gold and silver ownership. Not because people are paranoid, because they learned the hard way what inflation really means. Now let me make this practical. If you're watching from the US, you don't have to predict the apocalypse to understand the opportunity. You just have to recognize the direction of pressure. We have a debt load that keeps growing. We have political incentives that favor easier money. We have an investor class that's starting to question whether holding long-duration paper at low real yields makes sense. And we have a metals market that's already telling you something is shifting. And just when you think that's the whole story, there's another layer that most people ignore. Silver is not just a money metal, it's a working metal. From recent market updates, a larger share of silver demand is tied to industry than most people realize. Electronics, power infrastructure, solar, and yes, the kind of data center build-out that's eating electricity like it's an all-you-can-eat buffet. When the world builds more grids, more storage, more chips, silver isn't optional, it's part of the wiring. And here's the kicker. Silver is far less liquid than gold. That means when buyers show up at the same time, the price doesn't stroll upward. It jumps, it jerks, it overreacts. So if you're wondering why silver can go from calm to chaos in a week, that's part of the explanation. It's a smaller pool with bigger hands splashing in it. Now, I want to add one more piece of fresh context that wasn't front and center a few years ago. The way the world uses energy is changing. Power grids are being upgraded, not because it's trendy, but because demand is exploding from electrification, automation, and the data economy. Data centers aren't just rows of computers. They're industrial-scale power consumers. Every time another mega facility gets built, it pulls on the supply chain for transformers, cables, connectors, and all the boring hardware that actually makes electricity usable. Silver sits inside that boring hardware. So, when you hear industrial demand, don't think of a gadget, think of infrastructure, think of years of build-out. And when you combine that with the reality that above-ground inventories can be drawn down quietly for a while and then suddenly become the headline, you get a market that can go from no problem to we have a problem in 1 quarter. That's why I don't dismiss the volatility, I respect it. Volatility is the admission that the market is unsure how to price scarcity. Now I want to pivot to the big question. What do we do with this? Because watching markets is entertaining. Positioning is the point. I'm going to read a viewer question that sums up what most of you are thinking. The question is basically, where do you see gold, silver, and mining stocks going from here, and how do you balance the risk? Here's my answer, and I want you to hear the tone. Confident, but not reckless. Gold and silver can absolutely go higher from here if the dollar continues to weaken. And the current setup suggests that's not a crazy statement. But the path will not be smooth. Silver especially will mess with your emotions. That means your plan matters more than your prediction. Now, in terms of targets, I'm not going to pretend I have a crystal ball that spits out one perfect number. What I do have is a map of zones. If the dollar index keeps sliding, there are reasonable next levels for gold that sound unbelievable, until you remember we're talking about money being repriced, not rocks becoming more magical. And silver, because of its volatility and its industrial squeeze, can overshoot in ways that make both bulls and bears look foolish at different moments. But here's a counterpoint that needs to be said because the competitor narrative out there is a little too clean. Dollar down does not always mean metals go straight up in a line. There can be moments where a risk-off shock forces selling across the board, including metals because people need liquidity. It's rare, but it happens. So, if you're building a plan, build it with room for turbulence. Now we get to the fun, dangerous part, the miners. Mining stocks are leverage. They can turn a metals move into a bigger move. They can also turn a bad week into a stomach punch. People love to talk about 2 times leverage like it's a law of physics. It's not. Sometimes miners lag. Sometimes they lead, sometimes they get crushed because of costs, politics, dilution, or bad management. So the correct question is not, will miners beat silver? The correct question is, which miners in which environment with which risks, and what's my exit plan? That's why I think the smartest approach is a balanced one. If you only own miners, you are not owning the metal. You are owning businesses that happen to pull metal out of the ground. Businesses have expenses. They have capital needs. They have jurisdictions. They have shareholders. If you only own metal, you have a simpler form of exposure, but you might miss the upside that comes when the market re-rates the companies. So the way I look at it is like building a team. The metal is your defense. The miners are your offense. And you don't want an offense so big it costs you the game. Now, let's talk about something that's been glaring lately. And let me be the skeptic for a second because you need this voice in your ear. Yes, miners can be undervalued. Yes, they can rip higher. But miners also have a bad habit of disappointing at the worst possible time. Sometimes the metal price goes up and the miner goes down because the company issues shares or misses production, or gets hit with a tax change or faces a permit delay. The metal doesn't have a boardroom. The miner does. So if you want the upside without betting everything on operational execution, consider mixing in different types of exposure. Producers with cash flow, developers with catalysts, and even the toll road businesses in the space that get paid based on production without running the mines themselves. Those models can behave differently when costs rise. Also, don't underestimate geopolitics. A mine in a stable jurisdiction is not the same as a mine in a place where regulations can shift overnight. The market will price that risk eventually, even if it ignores it during the hype phase. That's why I'm always careful with the word cheap. Cheap can stay cheap. Undervalued can stay undervalued. The only thing that changes it is a catalyst and a crowd that finally notices. So, my approach is simple. I want exposure, but I want survivability. I want companies that can make it through a rough patch without begging the market for cash every 6 months because dilution is the silent killer of minor returns. And if you don't know how to spot that stuff yet, that's exactly why the members-only research exists. It's not magic. It's just doing the boring work consistently. Silver has been ripping, but some miners have not matched that move in the way the textbooks would suggest. That disconnect is either a warning or an opportunity. Why would miners lag? One reason is that investors don't trust the move yet. They think it's a spike. They think it's going to mean revert. They're waiting for confirmation. Another reason is cost inflation. If energy, labor, and equipment costs rise, a miner's margin can get squeezed even as the metal price rises. And another reason, which doesn't get enough attention, is that a lot of generalist capital still isn't in this space. When the big pools of money finally rotate, miners can get repriced fast. Until then, they can look cheap for longer than you think is reasonable. This is exactly why I keep telling you, don't fall in love with a ticker, fall in love with a process. If you're going to buy miners, you need to think about balance sheets, cash costs, debt maturity, and how management funds operations. According to the latest publicly available filings, you can spot weak companies by how often they have to raise money and how little progress they make per dollar raised. All right, back to the timeline because we're not done with the dollar story yet. Here's what I'm watching next, and this is the part that could surprise people. The dollar index has been wobbling around the mid-90s, and we just watched it print a fresh low and then bounce. That bounce is exactly what gets people comfortable. They say, see, it recovered. False alarm. But if the next bounce is weaker, if the rallies get sold faster, if the index keeps failing to reclaim the old support as support again, that's when the breakdown becomes real. That's when 90 starts looking like a magnet. And if 90 breaks, the market starts pricing the next stage, the idea that the strong dollar era is not a default setting. It's a policy choice and a confidence choice, and both can change. You're already seeing official language that says strong dollar while the market does the opposite. That gap between words and price is where the story lives. Now let's tie this into gold and silver pricing in a way that makes sense. Gold is the big ship. Silver is the speedboat. When fear rises or currencies weaken, gold absorbs massive flows because it's deep and liquid. Silver gets pulled along, but it also gets shoved around by industrial demand, inventory constraints, and thinner trading. So if gold keeps pushing higher while the dollar softens, silver can do what it does best. Overperform, then terrify you, then overperform again. That's why the key is not guessing the top. The key is managing the ride. If you're holding physical, you can treat it like long-term savings. If you're trading paper, you better respect volatility. And if you're in miners, you have to respect the fact that miners can gap down on a headline that has nothing to do with the metal price. Now, I promised you we'd keep the structure tight, so let's land the mining discussion with a practical framework. 1. Decide what percentage of your metals exposure you want in physical. That's your bait. 2. Decide what percentage you're comfortable putting into miners, knowing it can swing harder. 3. Diversify within miners because single name risk is real. 4. Plan your profit taking. The market does not ring a bell at the top, but it does offer exits on the way up if you're paying attention. If you do that, you're not gambling, you're participating. Now let me circle back to the bigger picture because there's a reason I'm pressing hard on this right now. A lot of people are waking up to metals after the move, not before it. They see a chart, they feel regret, and they chase. Don't chase. Use pullbacks to build. Use strength to trim risk. And remember why you bought in the first place. If your thesis is currencies are being debased and hard assets protect purchasing power, then short-term volatility shouldn't shake you out of the position. But if your thesis is, I want to get rich next week, then you're going to get emotionally wrecked by silver's personality. And speaking of silver's personality, let me leave you with a cliffhanger that matters. The story in silver is not just price, it's availability. When industrial users need material, they don't care about your chart pattern, they care about deliveries. And when the market senses that physical tightness, paper pricing can disconnect in weird ways. So the real question for the next phase is this. Do we get a sustained squeeze where physical demand stays elevated while the dollar softens? Or do we get a volatility washout that scares weak hands before the next push? Either way, the setup is not neutral, it's charged. Now, I want to hear from you. Do you think the dollar index holds 90 if we get there? Or do you think it breaks and accelerates? And second, are you more comfortable owning physical, or do you prefer the leveraged upside of miners? Drop your answer in the comments. And again, if you're successful, share your success story in the comments so others can stay motivated. Seriously, it helps more people than you think. Before I wrap this up, let me remind you the description has those bonus links, including the premium WhatsApp channel link and the channel membership join link. If you want the members-only videos from the separate research team, that's where you get access. One more thing on the dollar before we close, because this is a big deal and most people miss it. A lot of the dollar's strength over the last couple of years has been tied to real yield, meaning what you earn after inflation. When real yields are positive, holding cash and short-term paper feels rewarding. When real yields get squeezed or turn negative, the incentive flips. People start looking for assets that can keep up. If we get a world where rates are cut while inflation stays stubborn, even if it cools a bit, you can end up back in that negative real return zone. And historically, that's been gasoline on the fire for metals. Not because everyone becomes a gold bug, but because the math pushes people away from guaranteed losses. That's also why you'll see sudden waves of interest from people who never cared about metals before. They're not joining a movement, they're just refusing to be the sucker at the table. So when you see a headline about rate cuts or policy easing, don't think only about stocks. Think about the currency. Think about purchasing power. Think about the long game. That's where this whole story points. All right, last thought. When the crowd is calm, you prepare. When the crowd panics, you execute. Right now, we're in that weird middle zone where the evidence is mounting, but most people still don't want to believe it. That's often the best moment. Stay sharp, stay patient, and don't let the noise steal your plan. This is for education and entertainment only. I'm not your financial advisor. I don't know your situation, and I'm not telling you what to buy or sell. Do your own homework, think in scenarios, and only take risks you can live with if the market goes sideways before it goes your